Hello everybody, I'm Cantonese Cat. Hey everybody, Cantonese Cat here. A special collaboration again with Luca from Cryptic Trades. You can follow him on X as well as his YouTube channel, Crypto, go by the same name here. Please, if you enjoy the collaboration, let us know. We'll continue to do this. It seems to be pretty well received last time. Alright, here it goes. Bye.
Hey everyone, Luca here with a special collaboration for you with Cantonese Cat. How are you, man?
Hey, I'm good. Thanks for doing this. Always enjoy doing these things with you.
Yeah, man, I loved our last talk together on the broader macroeconomic environment and Bitcoin. Today, we're going to have a special topic about Bitcoin miners. So, first things I would like us to emphasize about the importance of having a complete fundamental analysis. Over the last couple of years, we've seen how small caps were impacted by quantitative tightening. And this is very important, especially that small caps have the tendency to be impacted most by monetary policies and the broader macroeconomic environment. Now, the thing is, we've seen small caps basically bleeding and being in a bear market for the past 4 years as the Fed has started to transition away from their quantitative easing measures back in 2021. And then later on, when they have implemented their full quantitative tightening policies back in 2022, when they also start to raise rates and the total assets start to go down. Now, this is very interesting because, as we all know, small caps always need cheap capital and low interest rates in order to fund their operations. When they do not have access to that cheap capital, most of the times they have to attract financing some way. And they do that by diluting their shares. And this is also why the stock's price tends to suffer in these periods. Now, this is why tracking the macroeconomic data and the monetary policies of the Fed is so important, especially when we invest in the small cap sector. So, what are your thoughts on this?
I actually have some thoughts about it later on that I want to show you. I think that this is a very important chart to kind of illustrate in terms of what has been going on really over the last few years. It hasn't always been like that. I always thought that the small caps, not everybody basically have this conception that small cap is underperforming large caps, and that whenever you have any badness happen or any shakiness happen, small caps always going to get getting dumped, and it's safer to be in the large caps. And I think that mentality has always been the case. It does have some tie-in in terms of macroeconomics, but I also think that these things are more cyclical than anything. And I think the cycle between large caps and small caps are actually more spreading towards like decades. And I think the trend may be starting to decelerate here a little bit. I'm gonna try to show you that a little bit later. But it's been the case and it's gonna be the case until it's not. But I think that things might be shifting.
Yeah, exactly. Especially that we've seen inflation basically cooling off over the last couple of months. So we've seen three consecutive readings below 2.5%, which is giving us a clear indication on where monetary policies are headed next. And that I think is the end of quantitative tightening. So I was thinking if the main catalyst that led to small caps underperforming over the last couple of years will go away, and if the total assets bottoms out, then what could happen to the performance of small caps against the big caps and the big equities in the S&P 500? I think that we're going to see the opposite of what we've seen over the last couple of years, which is this midterm reversal as we enter the cycle top formation in equity markets as well. What are your thoughts on this?
If you track the higher time frame, like I basically I like to look at these things usually on like the weekly and monthly. And on the monthly, I've been seeing some bullish divergence that's been building up, that tells me exactly kind of what you're alluding to, that there could be a reversal in terms of the small cap underperformance. I also think it's very, very interesting that the quantitative tightening is really looking like it's decelerating significantly, which is setting up for a perfect macroeconomics environment for small caps to actually do pretty well moving forward.
So another interesting thing is how interest rates have impacted the S&P 500 so far. Now, I believe this tells a very important story about how the risk appetite impacts the S&P 500 and the broader markets. Basically, what we've seen over the last couple of years is the S&P 500 being in this major bull market because the monetary policies were stable, interest rates were kept at the same levels, and that has led to a higher degree of confidence and a higher risk appetite from investors. Now, this leads to more investments and it leads to also to higher prices. Now, of course, back in 2023 and all throughout 2024, we've had a very good macroeconomic environment. So we've had a pretty low inflation rate, a high economic growth, and a resilient and strong labor market, which of course led to more certainty and confidence in the economy and in the broader macroeconomic environment, which led, of course, to higher prices. And the way I see this now, moving on from here, and I would like to hear your thoughts on this as well, is I believe we're going to see a very similar period to the one we've seen all throughout 2023 and all throughout 2024, where the Fed will keep holding their interest rates at the same levels as the CME Fed Watch tool currently shows us. The upcoming rate cut is being priced in September. So that gives us a nice 3 months before we'll see any intervention from the Fed. And while they'll have stable monetary policies, we will see a very similar risk on period to the one we've seen back in 2024, which led to higher prices in equity markets. But this time, however, because from a cycle perspective, we're nearing the end of this bull market, I believe the main spotlight will be on risk assets. And I believe we'll enter a complacency phase in traditional equities and big indices such as the S&P 500 and NASDAQ and the DJI, while liquidity starts flowing into risk assets. So what are your thoughts on that?
Yeah, I mean, over the last couple of years in 2023, 2024, the large cap companies who have really good cash flows, who really don't have any debt. I mean, you're talking about companies that are just holding like billions and billions of cash. They do extremely well in the high rate environment, and their earnings have shown that, and their stock prices also reflected all that. Whereas a little bit more of like those cyclical type stocks like Tesla and other, small cap type stocks, they are more sensitive to, economic environment and rates, and they have really kind of underperformed, right? So at some point, the large market caps that these large caps have developed, the money is going to end up rotating out to smaller caps. I think they're just trying to find an excuse to do that, while I actually think that the whales already kind of seeing the greater picture. They have been accumulating small caps for years, and I think they're just waiting for it to pump, and they're just waiting for an excuse. So to me, I all the macroeconomic environments are there for the rotation to happen. It just simply hasn't happened yet. And on top of that, I think we're still waiting for that final push of liquidity to come in. And everybody's been so bearish on the market for the last 2 or 3 years, especially when it comes to China, that once we continue to have that liquidity kind of flow in, once inflation is not an issue anymore, it really hasn't been. And also once the quantitative tightening is ending, once China continues to print their way out of deflation, it is setting up for perfect rotation into small caps, my man. I mean, I agree with you completely.
Yeah, I mean, we discussed this in our last market talk as well, the global liquidity and how China plans on to stimulate their economy and to print their way out of depression. And I believe it's all setting up to be this perfect build up into this risk on environment that precedes the cycle top. So think about it. The most bullish narratives emerging right when there are the most risks.
The S&P 500 has just gone up so much over 2023 and 2024, and a lot of people are still remaining bearish, which I mean, certainly the April dump didn't help, but I think that is just overwhelmingly majority of folks are still very cautious and very bearish, and we simply haven't had that risk appetite coming back yet.
Yep. But do you think that is a bad thing or a good thing that the risk appetite still hasn't come back yet?
I love it. I mean, if you're talking about the macroeconomic environment actually improving, you're talking about liquidity conditions actually getting better, but people are still focusing on whether or not the Fed would cut rates, whether when we just kind of show that it may not matter as long as it's stable, right? Market wants predictability, they want stability. And as long as there's not anything that's kind of throwing us off, I think it's okay. But people getting distracted with all kinds of things like tariffs, trade conflicts, and now they're talking about like the Middle East conflicts. Like everything is just it's like the same narratives over and over again. People getting scared over and over again. But I think we've seen this movie before, and those people who really know what's going on, I think they are doing what they're needing to do to get them set up for the next run up, whereas people who are getting scared are continue to be on the sidelines. There's no money on the sidelines still, and the narratives are still bearish. That's a good thing. Yeah, so a couple of things I was kind of wanting to go back to mention. On the left side over here is the 10-year yield. And on the right side here is the Russell 2000, represented by the ticker symbol IWM. What you're really seeing here is you showed me earlier about the Fed funds rate, but the reality is the market follows more the actual condition, which is based on the 10 year. The 10 year is what a lot of people really kind of pay attention to. The interesting thing is, even though the Fed has held rates up to like 5 point something percent for a very, very long time, and when they said that they're gonna, stay higher for longer, they really meant it. Yields have dropped. Like the peak of the yields was back in October 2023, and that was really the bottom of the IWM. It coincided perfectly with the bottom of the IWM. The Feds didn't really actually start cutting rates really until September of 2024. And that was when they really start cutting rates, right? And people are like, oh, they're finally cutting rates, so IWM must be going to the moon. And then they end up tricking everybody by giving you that November candle to double test the previous all-time high and then end up just rug pulling you after that. Even though the Fed funds rate had been staying the same, 10-year yield has been dropping from like 5% all the way down to, 3.6%. And as soon as the Fed says that we're going to cut rates, guess what happens? The 10-year yield shot up just to throw you off, right? And whenever they said that they're going to stop cutting rates back in around like January of 2025, 10-year yield dropped. I think that liquidity conditions runs based on the market, and I think the Fed and Jerome Powell they lag behind. Even themselves say that they are data dependent, right? So if you look at the yield condition, even if you look at the RSI here back in the days, you knew that there was the RSI for the 10 years getting exhausted, right? As you continue to make a higher high here to 5%, RSI is dropping down here on the monthly. Like this is very, very topping kind of signal. So this is also coinciding with the bottom IWM. What I'm trying to say is like I don't really want to follow what the Fed does because they're lagging. I want to follow what the real market condition does. And that's what the 10 years telling me. IWM bottom in October 2023, 10-year yield top at 2023 as well at the same time. So I follow the market conditions. I don't follow what the Fed, the talking heads are talking about. I just don't do that. The other thing too is when you're referring to the Russell 2000 and the S&P 500, the large versus small cap argument, you're extremely correct. Over the last 5 years, small cap has just been wrecked compared to large caps. This is the Russell 2000 over S&P chart, so RUT over SPX. And with this symbol, I can actually go back to a lot further. I can actually go back all the way to like the 1988. And what you're seeing here is this, right? Like during the dot-com bubble, large caps were just going like crazy, right? So small caps underperformed that, and then the bubble crashed, and everybody rotated from large caps over to small caps like financials and housing stocks. And the small caps ended up outperforming the large caps by a lot over the next decade until you really start to have the great financial crisis when you have, small caps starting to, crash together with the large caps. And then that's when you end up having the rotation back in the large caps over the last decade and a half, 2 decades. And that right now it's just been over exaggerated. And back here, the small caps, they're still outperforming large caps all the way up to like maybe 2011, right? On bearish divergence. Now what are we having? We're having large caps outperforming small caps for the last 5 years on bullish divergence. And this is on a monthly chart. So that tells me that I think it's going to the extremes here on bullish divergence. I think it's just a matter of time where things would end up just rotating. Because the common sense right now is large caps outperform small caps. And that's exactly the kind of complacency that I worry about the market participants, just keep on having the same thoughts over and over again. So yeah, I agree with you too. From this particular like decade long cycle, I think a change might happen, and I think the change might actually happen for a lot longer than just short term. Thoughts on that?
I mean, I have an interesting thesis about that, but I believe we're gonna see something very similar to what happened in the Roaring Twenties.
Mm,
So that's a big topic.
mm.
With all the technological advancements, with what happened back in the 1920s, basically what we've seen with the Industrial Revolution. Now we have the AI revolution,
Yeah.
and we also have very similar macroeconomic environment. So I believe that we're gonna see in the next couple of years a hyperinflation environment where small caps are likely to outperform, and this chart beautifully highlights that.
I want to show you something else that I was posting on X earlier too. This is the ARK Fund by Cathie Woods over QQQ. You know how ARK Fund has been bleeding. You know, they're full of all kinds of speculative, high debt stocks, and they have been just absolutely destroyed over the last few years after that bubble from 2020, 2021. If you actually chart that against the QQQ and you do a spread of ARK over RK over QQQ, something interesting is happening too, and I do think that there might be a rotation coming to support your Roaring Twenties idea in terms of innovation, things like that. And first of all, like our fund, they have like the top holdings like Tesla, Coinbase, Shopify, those kinds of high beta stocks that are more liquidity sensitive. If you just chart this spread here, you can see how ARK Fund has underperformed the QQQ for about 3 or 4 years straight. It was just absolutely brutal, right? But with the monthly Bollinger Band being turned on and with the 20-month moving average here being shown, you can see that the 20-month moving average initially was support and it became very, very negative sloping during this big bear market of ARK Fund. And then it became resistance here. But guess what? It has flipped the 20-month moving average from resistance here back into support. And we are also really showing a very, very nice trend change here. And right now, we just bounce off of this 20-month moving average. We could be favoring those ARK fund type stocks over large caps here too. You're not just talking about, small cap. We're also talking about these high debt speculative stocks here as well.
Yeah, definitely agree. I mean, the risk on environment primes all risk assets and all risk investments, right? And I think that the charts always tell a story before the news and before the narratives emerge. I think that this bottoming formation definitely tells us that risk assets are likely to start outperforming in the next couple of months. Another thing is right when we approach the end of any major bull market, that's generally when risk assets start to outperform. Then we sort of have this distribution. The reason why I think this distribution happens in the first place is that we have a very high risk appetite. I believe the correlation between risk appetite and the broader cycles is very interesting. I believe that the very high risk appetite is what leads to distribution phases in the first place, because that's how market makers can start to distribute whatever they have accumulated.
It absolutely is the case. I mean, I've always think that whenever you have distribution, which is why I actually don't think distribution is bearish. I actually think that distribution is bullish because they're trying to pump the market and they could be doing that for quite some time. There are some really high beta stuff that they're trying to pump the market for like a few months and then and then that was it. Everybody gets euphoric and that was it. But there's always some distribution cycles that can also last longer too, which can last for years. That note too, I also want to show you one chart, and this is the QQQ over SPY chart. In general, on a more risk-on environment over the last, really 2 decades, generally the QQQ or the Nasdaq does better than SP 500 or SPY. And you can see that over time, over the secular bull market for the last decade, decade and a half, it's been the case. Like QQQ just outperformed SPY, except for that really euphoric stage with really significantly increased liquidity from 2020 to 2021 that really had gotten us like way outside the upper Bollinger Band for a very long time. This is a QQQ over SPY spread, by the way. So if it looks bullish, that means that QQQ does better than SPY. And this really significant outperformance here, I think that's exactly kind of what you're referring to. They are trying to distribute these really higher beta stocks to get more risk on here, but it was just way too much, and they got everybody all euphoric. And then that's when things crash after they're done distributing all these to retail, right? And we have a bear market where the Nasdaq dropped like 38% and the S&P 500 I think dropped like 26% and it's significantly underperformed. And guess what? Right now, overall, we've had the QQQ kind of getting picked up here again. And overall, they've been doing about the same in terms of SPY and the QQQ, but they're getting ready for the next move here. I see this as a little bit of like maybe like a little bit of a continuation pattern of a cup and handle kind of thing. It's getting ready for something here. And the Bollinger Band is squeezing. So I think that there might be some further outperformance of the QQQ over SPY coming soon, which is going to be, basically increase in risk appetite. The reason why I think it's going to go to the upside after the Bollinger Band is done squeezing and start expanding is because it's on the upper part of the Bollinger Band and because of this pattern that I'm seeing here. And that's what I'm seeing, Luca.
Yeah, I mean, it's definitely hard to stay objective. One of the hardest things in investing is not developing a strategy or to have a fundamental analysis or a technical analysis, but it is to stick to it, right? Because it's very easy to build it, but it's very hard to stick to it, especially when you're in the heat, when you're in the moment. It's very hard to stay objective to your own plan and to your own strategy. So I think that the easiest way through which we can remain objective to our own analysis is by having objective data and not biased interpretations of headlines or ideas from others, but by having our own analysis and by tracking objective charts and objective data. So yeah, as you emphasized beautifully there, the technological stocks have been outperforming the S&P 500, and I think there might be some correlations to why that happened in the first place. As I said earlier, I think we're on the verge of having the second roaring 20s where technological advancement will once again take over. And yeah, that's why I think that tech stocks will most likely continue to outperform the traditional. And these were the two scenarios I highlighted at the time from an Elliott wave perspective. So let's now move on to the charts and see what happened next. So moving to the charts now, we have CleanSpark, and what we see here, this is where that post was made. We've had this brief bounce to the upside and then a continuation to the downside, basically breaking below the September lows, as you guys can see here, and also breaking its high time frame and also breaking its bullish high time frame market structure by forming this series of lower highs as well as lower lows, as you guys can see here. So for this reason, my current base case is that we could see this next reversal ending up in a complacency phase. So for this reason, I'm now considering the possibility where this next reversal ends up being just a complacency phase, just as I showed in the post from the beginning of this year. And this reversal actually leading up to a complacency phase, something similar to this, failing to form a new high that would eventually precede the bear market. So what are your thoughts on this?
First of all, I want
Yes.
to applaud you for having an alternative scenario, because I honestly think that nobody really knows what the future holds. I think it really matters in terms of what you're seeing and what levels you have for valid different scenario. My thought is that I think Clean Spark has been extremely challenging to chart, to say the least. I think looking back at it, hindsight is 2020. I can show some of my Clean Spark charts here in a second, but I still think that it runs with the IWM and the whole global liquidity phase. I still believe that CleanSpark was one of the early runners throughout 2023, and I think it just went way too far away to think a lot of people are actually getting more complacency to the downside. When we actually have Bitcoin, making all-time highs, when we actually have global liquidity rising, when overall IWM seem to be, forming definitely something to take into consideration.
Yeah, I mean, I'm personally really bullish as we discussed earlier on risk assets in the next couple of months. But this is something I'll be keeping in the back of my mind. I think that being conservative right now is not such a bad idea, especially when we reach these levels. Because in that post I showed you earlier, I also mentioned that I won't be looking to sell here because that would be just a dumb decision. You would basically sell at the bottom after the whole dump. So instead, I'm gonna look forward to fundamental side, as we discussed earlier, with the currently bearish technical side from this lower from this lower high and lower low standpoint. So yeah, this is my approach moving forward. What do you think?
It's always good to be cautious, although in hindsight, again, hindsight is 2020, the time to be really last year or so, we started having, some bullish divergence that's being built up during this downward trend here, especially on the weekly, as you can see. So because of that, it actually gets me divergence. That was really the start of something great, right? And we've been building a very, very similar bullish divergence there for a long time, and now everybody's cautious. So I'm not saying that you shouldn't be cautious. What I'm saying is that maybe not be that cautious until you hit some of the key levels, like you're showing, and then can turn into something else. So I just want to be, cautious both on the upside and to the downside because you always have upside risk and downside risk, and you can't just be looking at the downside. You also have to reassess as it recovers because sometimes it can turn into something else.
Yeah, what do you think on this high time frame falling wedge? This is something I've been tracking over the last couple of days.
Yeah, it looks great. So again, if you're into elite wave, I actually wonder, and I'm not an elite wave, specialist or chartist or anything. I dabble in it. I kind of know the understanding of theory and things like that. I actually wonder if the 2025 is just a big giant wave too. Like,
That would
yeah,
be certainly something. Yeah, I've been thinking about this as well. That
yeah,
would also could correlate beautifully with that transition into a risk on period.
it can. That's another alternative scenario too, right? That we cannot neglect. Because if that's the case, then, and based on also the current sentiment, like that could really lead.
Definitely. What do you think about the latest institutional ownership rise? Because we've seen the institutional ownership absolutely spiking in these Bitcoin miners over the last couple of months. And it's gotten to the point where I think the institutional ownership for CleanSpark currently is around 75% or something like that.
It's absolutely ridiculous. I mean, I think that, and I don't want to be like conspiracy theory because there you look at where you want. There's a theory out there saying, like some people are saying, oh, they might be institutional buying, but they could be letting out to people to short, and then there are also folks that are saying, oh, because the dilution, you have institutional just buying, but the dilution is keeping the price down, is actually not a good thing. Like you have a lot of people, like somebody who mentioned, you have increase in institutional ownership to a certain point. If most of it is being held by institution, then all the upsides already, been played out, right? Like, you don't have any more institutional buying pressure. So there's people who argue that, but to me, I feel that right now, a lot of the selling pressure are mostly from and they're shifting hands to institutions because the REIT bought in the 20s are absolutely regretting it. So to me, I feel that the selling declining as evident by the bullish divergence that you just shown. And I think that we might be starting to run out of sellers soon. And with institutions most likely being stronger hand than retail, I want to keep the alternative scenario of this downtrend potentially being wave two if institutional ownership, they increased their ownership from like 40% just like a year or two ago now to like 75%. That's a huge change. And when you have the strong hands holding the stock, and we were just talking about distribution earlier, I mean, I feel more bullish about it, and I don't necessarily buy like the institutional lending out to shorts and and that kind of narratives. But interesting in your thoughts too.
Yeah, I mean, I think that at the end of the day, it's a level by level market, and this is how it should be approached. Or to the bullish scenario playing out, where this is actually a major reversal. And I think this is pretty much the level we have to clear in order to confirm that the bearish thesis is not happening. So at the end of the day, it's a level by level market. And no matter how bullish or bearish we might be, for that matter, I think we should be ready to adapt to new market circumstances. And I think that what really tells us the truth about the markets are the charts and how the price action develops. And the story tells about the risk appetite of investors at the end of the day. Because right now we're seeing extreme capitulation on these Bitcoin miners. The sentiment is absolutely at its all-time low. Everyone has mostly capitulated or even forgotten about these Bitcoin miners. And you know, it's it's expected since they have underperformed over the past few months. But it also creates an opportunity. Buying CleanSpark around $6 was deal for me, and a lot of Bitcoin miners were very cheap. I think Mara even got into single digits as well back in early April. So those were great opportunities, right? And the way I see it is a lot of people have given up on these Bitcoin miners, have mainly transitioned to other investments, right? There are a lot of stocks that have been replacing Bitcoin miners in terms of the new thing, in terms of the new shiny thing, right? We Something I've been tracking was HIMS, their miners in order to transition to HIMS, and that has been really interesting to me. Selling something that has underperformed, which has a high likelihood of outperforming in the future, to buy something that has outperformed already and it's likely to underperform on the midterm at least. So
Yeah.
it's definitely very interesting to think about this way from a psychology perspective. I think that human psychology plays a major role in shaping the markets.
Yeah, no, it's very, very sad for sure. I mean, whenever Clean Spark was up in like the 20s, I basically was like, yeah, I'm not gonna buy there. I think that minimally there should be like a 3 to 6 month correction period. I just didn't expect it to like last for 15, 16 months. Like this has been a very, very brutal. I guess that's what it took to really think we're actually at a point where it's unfortunate. I wish that retail investors and traders won't do that, but I would not sell miners at the low and try to rotate into HIMS, which is has been overextended. Also mentioned like 62 to $64 is a pretty strong resistance level, and when it hit there, it's been having a hard time getting through it. But people just rotate into it, so it is what it is.
Yeah, I mean, on the high time frames, this has been mostly distribution phase where all the retail euphoria was in, where everyone was buying into these miners. And now it's pretty much an accumulation phase where institutional investors have increased their ownership and their exposure to these Bitcoin miners, and most likely expecting something that is coming in the next couple of months, whether it could be political support from the pro Bitcoin Trump administration or whether it could be something else. Something else I've been tracking is also the hash rate index, which tells us how much money these Bitcoin miners make per exahash. And interestingly enough, we're seeing it pretty much at the lowest levels it has been over the past few years, which tells us that there's only room to grow from these levels. And that even though the industry is very competitive, because we could see the Fed finally transitioning away from their quantitative tightening policies, allowing cheap capital to enter the market and so forth, and access to low interest rates, that I think could act as a catalyst for these Bitcoin miners and create an alternative source of financing rather than dilutive measures. And like we've seen with CleanSpark, um, something I really like about CleanSpark right now is that they have given up on their dilutive measures and instead they have started to use their Bitcoin reserve in order to finance their operations. So, what are your thoughts on that?
Yeah, the market cap for CleanSpark is like 2.6 billion. Is nothing. I think it doesn't take a whole lot of liquidity coming in to really pump the stock. People are still heavily shorting it. So as soon as the technical improves, and if we end up going for the bullish scenario rather than the bear scenario that we had earlier, it can really run up in a rocket just because the market cap is extremely small. The whole thought, I'm going to make a comparison to in terms of Nvidia. I remember back towards the end of 2022, the prevailing narrative is that we have a huge chips inventory. Nobody was using chips. If you buy into a stock like Nvidia, you're out of your mind, right? The narrative is basically putting in the fundamentals to the point that is so terrible, and that's exactly when Nvidia bottomed. They continue to, I remember for months after that, they continue to talk about Nvidia's like chip build up, things like that for months after that, like all the way up into the first half of 2023. I was still seeing posts on X, or formerly known as Twitter, but I was still seeing like posts on it over and over again saying chip inventories an all-time high, AMD, MU, Nvidia, and that they already bottomed. They already look like they're forming higher highs. Like that's the kind of thing that if you based on what the prevailing narrative is when things couldn't get any worse and you believe in it and you don't look at charts and you don't think through, hey, sometimes there's a lag in terms of these kind of chip inventories, like the market usually is a few months ahead of time and you're missing the charts, you're missing the price action. If you're not seeing what's happening with the institutional accumulation, then you're missing the move. And if you're just based on these lagging narratives and lagging fundamentals, then you are going to, not do very well. So,
100% agree with you, man. Yeah.
yeah,
Would you mind sharing your charts as well?
yeah,
I would
absolutely.
love to see yours.
Action here for almost the entire year and a half. Guess what's happening right now? We're entering the cloud. We are holding the zero point 0.5, probably end up gravitating back up here to the 0.618 or the 0.707. 0.707 was kind of like the level that you were talking about earlier. And I think that's a very, very important level to break. If it's able to break back, once it gets there, and if we break that, then some of the hard targets are possible. And I'm not even going to talk about what the hard targets are because I think it's kind of dumb to say one level at a time, right? But it's kind of crazy how right now the top of the Ichimoku cloud, which is going to be resistance level right there, is right at 0.786 lock fib. There's a lot of confluence there, and I think that the cloud here is telling us a story. So that's kind of what I'm thinking about Clean Spark here. The other thing I also see that I like to look at the 20-month moving average. Once it breaks underneath of that, I get a little bit iffy about a stock unless it breaks back above back test and go higher. I think it's in the process of doing that. So I need to see it really clear like the 11 and a half, $12 level and then reclaim that level from resistance to support. And then I'll be a lot more confident about like the higher time frame, bullishness, but we don't really have that quite just yet. So, um, thoughts on what I'm seeing, I don't know. I know you're not usually one of those folks that look at Ichimoku Cloud. I just thought that it was interesting that it re-entered Ichimoku Cloud this month after being rejected for so long. And the more you test the resistance, the weaker it gets. I think we finally entered a cloud. So fingers crossed and see whether or not we can gravitate back up to here one level at a time.
100%. I think that's a very good highlight there. One level at a time.
Yep.
Yeah, it's a level by level market, and really, nobody really knows what will follow next, right? We can only speculate on what will follow, but at the end of the day, we don't really know. So I think that taking the markets level by level, not being biased about anything, not being all too bearish or all too bullish, but simply adapting to new market circumstances while also sticking to a long-term objective strategy or plan that you have developed multiple and through multiple confluences, fundamental analysis, technical analysis, and so forth. I think that's the best approach an investor can take. And now talking about Bitcoin miners in particular, I believe that On the long term, they are looking extremely undervalued, right? A lot of these Bitcoin miners have business operations that are worth billions, and a lot of these Bitcoin miners have also got Bitcoin reserves, also got Bitcoin's reserve, which are worth billions, and they are really, really undervalued, right? Their market cap is absurdly low. So for this reason, I believe that on a long-term basis, even though the sentiment might be in capitulation territories, even though a lot of people might have given up on these Bitcoin miners, the most likely and reasonable outcome is for them to outperform moving on from here. So I think that with this broader bullish thesis in mind, tracking whether we can clear certain resistance levels in the next couple of days and weeks will be crucial. And adapting to new market circumstances will be just as important.
I completely agree with that. I also want to circle back to our talk earlier about the broader market, about how there's potentially a rotation from large cap to small cap and also more speculative stocks. It doesn't get more small cap and speculative than Bitcoin miners. It doesn't get more spec. Kind of line them side by side over here. I'm trying to show you is that this is all a liquidity game. And whenever there's sentiment going in and whenever liquidity is going to small caps, and Bitcoin miners are small caps, I think that they would benefit from that liquidity. And I think that once IWM starts to make all-time highs again, I think the miners will end up flying together with it as well. Because if you just start the sequence of fit level from February, or I guess this is January, January, February 2022 to the bottom over here, you can see how they actually line up very well with the fit levels. They basically are the same. When the IWM was having this, washout up here back in November 2024, the miners also look pretty good. Like there are certain miners like Iron and Wolf that really have outperformed. And whenever you have liquidity, whenever you actually have like a liquidity grab down here back in April, miners also dropped too, and they're both holding very similar levels. I think that it's basically a liquidity game, and I think that the accumulation have been done, and I think this is a reaccumulation. And we'll see what happens. That's why I always like to pay attention to what IWM does, because I really do think that the miners follow IWM actually closer to Bitcoin because they're businesses.
Definitely. And it's very interesting how couple of weeks and months. But yeah, I think that taking the markets level by level, adapting to each level and to how the price reacts after testing it is very important moving forward. But I believe the overall thesis remains bullish right now for these Bitcoin miners.
I believe so too, and I think we have another few minutes. I just want to also go through just one quick thing here, which is dilution of the miners. As you mentioned too, I think CleanSpark has already changed their strategy. This is Mara. And I wanted to point out this, I think this post I made a while back, like a few months ago, but the truth remains the same. Whenever they end up having the majority of the dilution, that generally happens during the euphoric phase. And the stock can keep going up, even if you end up doubling the shares and tripling the shares that everybody's talking about, because it just doesn't correlate. And honestly, comparing to dilution to the potential global liquidity, that could come in and the IWM liquidity that can come in, the dilution is probably nothing because these are actually very, very speculative and small cap stocks. All it takes just a little bit of liquidity to come in and for shorts to close their positions, and these things can move, in will. I'm just saying that I'm not sure if everybody just keeps on talking about dilution, if it's moving stocks from weak hand to strong hand and is going through reaccumulation range. But that's just my theory.
Yeah, I mean, we always need a strong narrative to shake out the weak hands. So
Yeah.
every time we have some bad incident happening, we need some. There are a lot of people who use the dilution narrative to justify the underperformance of Bitcoin miners. I think it's related to the sector as a whole. Small caps have underperformed because the risk appetite of investors has definitely went lower, and there isn't this, and we have yet to enter we have yet to enter the full-blown risk on phase in the markets, which I believe is coming in the next couple of weeks. On on the one on one side, that's a good thing because it signals that the distribution phase still isn't here and that the most likely outcome is for the traditional assets such as Bitcoin and the S&P 500 and so forth to go higher, because it means that the distribution towards risk assets still isn't here. And I would love to touch on this topic in the next collaboration about altcoins and what altcoins imply for what the performance of altcoins implies for the broader cycle of Bitcoin. I think that would be a very interesting topic as well, because a very similar thing is played by small caps for the major indices and major equity and traditional equities. When we have small caps outperforming, that signals that we're entering a distribution phase. But when they are underperforming, it signals that the risk appetite still isn't sufficiently high to lead to distribution phase. So that's my thoughts. So those are my thoughts on how the risk appetite has been impacted, and also how the risk appetite impacts the broader cycle and the performance of these Bitcoin miners.
Yes, I think the patience will be rewarded, as it always has time and time again, even though things may not.
Man, looking forward to it. Where do you think the biggest opportunity lies next?
I think the biggest opportunity lies next in stocks that people are not talking about. To be honest, I think miners are out of favor. I think altcoins are out of favor. I'm not saying that they're going to go to the moon immediately. They're like going to just V-shape out of the way, out of there. But um, in general, we I generally like to look at things when people are not looking at it. For stocks wise, I'm even looking at like other small cap stocks that people aren't even talking about that much yet. Pretty decent gain like Iron and Wolf. But the key thing why I'm able to stay afloat is because I did not over leverage. So
100%.
yeah, that's my last message I think to folks.
100%. Yeah, man. It's been a great market discussion with you.
As always, I'm looking forward to the next time, Luca.
Yep. It's been amazing. Thanks for joining this market talk, and I'm looking forward to the next one.